Good afternoon, and thank you for joining us for a periodic update to our thoughts and comments about the economy and the investment markets. My name is Joe Terril. I'm president of Terril and Company, private wealth managers headquartered in St. Louis with approximately $750 million in discretionary assets under management. Today is September 25th, Friday afternoon, 2015, and helping me today with the video, as always, is Brian Curtis. And Brian, if you're ready, let's go to our thoughts on the economy.
All right.
Any discussion of the world economy has to be centered around recent news out of China. China recently devalued their currency slightly, and they also basically announced that their economy is slowing down. Markets freaked out about this, if you will, with the assumption that there's some systemic problem there, and therefore China's economy is going to go into recession, severe recession, and it'll drag every other economy in the world down the tube with it also. Therefore, woe is us. It doesn't work that way. That's not the case. China's economy is export driven. They've seen the value of the euro, the Japanese yen, South Korean currency. Around the world, most all currencies are down 20-25% against the US dollar. Obviously, if their currency is a fixed exchange rate, they're losing some of their export business to German companies, to Japanese companies, etc. If I was advising them, I'd say devalue your currency in line with the other countries around the world. They're trying to do it in a slow and methodical way. It's not some type of systemic problem. They're also making an effort to move their economy to more consumer driven. This will be fine, and this will take a little time, but in the meantime, China's economy is not falling apart. Growth has slowed from 7% to something closer to 4%. We in Europe and everyone in Japan would love to have 4% growth. So it's not an issue of, oh my gosh, the economy is falling apart in China. In addition to it, it's not a domino situation where China will drag every other country in the world down with it. We had this in the 1990s with Japan. At the time, Japan was the second largest economy in the world. Japan went into recession, stayed in recession for 15 years, and it did not hurt the United States economy, and it certainly didn't hurt the world economy. This is not a scenario where one country around the world has economic problems, everyone else must also have problems. Emerging market countries that have been living off of selling raw materials are going to have to change and figure something else out that they can do to try and make a living besides selling just a mineral that's mined out of the ground or oil or something of that nature. But I hear and read comments by people that say this particular country in Africa is going to have 10-15% negative growth because of raw material prices collapsing, therefore it's going to wreak havoc with the entire world. Doesn't work that way. 0.25% increase in the United States economy means more to the world economy than the entire economy of small countries like that. So when people want to average and say, let's take the United States, put it together with a small Latin American country, African country, South American country, any type of emerging market with another country and divide it by 3, that's very poor economic logic. As a matter of fact, it's downright wrong. So we are somewhat bullish on the world economy yet. The European economy is turning around, beginning to show green shoots. The United States economy continues to do just fine. Housing's doing great. Automobiles are doing extremely well. We're seeing a good, steady economy in the United States with no indication of any kind that our economy is beginning to falter. So when you look at the overall picture of the world and the world economy, yes, if you happen to be Russia and you're dependent upon 65% of your income from selling oil and natural gas, you're going to have some problems, you're going to have some adjustments. If you're one of the smaller evolving market economies and you're dependent upon selling copper, you're going to have problems. The prices of those materials are not down because intrinsic demand for the products is falling, therefore there's something wrong with the demand side of the worldwide economy. Not true at all. They're down because technology has led to an abundance of supply. Productivity and technology are leading to all of these products being able to be produced in much larger quantities than they ever were before. It's a supply side situation on these products and most of these commodities. So when you put that together and look at the overall world and say, well, wait a minute, is cheap, abundant energy, cheap, abundant iron ore, steel, copper, all chemicals, all of these various products, a very cheap and abundant supply is very good for the world economy. Cheap energy prices aren't bad for the world economy, it's great. So if you want to look forward to what's the economy going to do in the next couple of years around the world, you must be bullish in looking at the fact that these prices of all the materials that make economies work are down dramatically in price. That's great for manufacturing. And if you want to throw in another one, the cost of money, the cost of capital to produce goods and services also is very abundant and remains at a cheap price. So put some of these events together and it's the rationale and the reasoning behind why we look for the 2016 and 2017 economy to be more worldwide growth. So worldwide growth overall that's maybe 3.5%. We'll take it. It's not going to go into a severe worldwide recession. So Brian, let's move on and maybe talk about the implication for investments around the world with that outlook for the world economy. Investment markets around the world have had severe corrections since the last time we posted a video. Mainly August and September have been, say it no other way than really lousy, whether it's stocks, bonds, or in between, as investment markets are worried and concerned about the world economy, corporate profits, and potentially what may or may not happen with interest rates, etc. So let's try and clarify some of this and put it together. As I mentioned in the previous part about the economy, the cost of manufacturing is coming down dramatically. That's not bad for the profit outlook for people in the manufacturing business. Everyone that uses energy, even if you are a technology company and you have 1,000 people working in an office building, the cost of energy coming down is good for your corporate profits. The cost of money all over the world continues to be very reasonable. And if anything, outside the United States, interest rates are still coming down. This is good for businesses, particularly those that operate on borrowed capital. So in general, we feel the corrections in the market are very much overdone as people have made the shift to the world economy is going to fall apart, therefore sell all these investments and run for the hills. And completely disagree with that strategy, and completely disagree with the notion that somehow corporate profits are going to fall dramatically. That doesn't take into account all the increases in productivity, all the ability to continue to cut expenses due to increases in technology. Put those things together, those are the things that keep corporate profits growing and will continue to keep them growing. That and 3.5–4% worldwide economic growth. So we don't share the doom and gloom that many other people do about investment markets right now. The United States last week Federal Reserve Bank of the United States was going to raise interest rates. They changed their mind. They thought, well, maybe we'll wait another 30 days. We want to see what's going on around the world. This got interpreted in a very negative manner, and I don't see anything there that the Federal Reserve Bank was so terrified about they refused to raise interest rates. If interest rates go back up to 1%, to 1.5%, that's not competition for existing stock and bond prices. You've got to come all the way back to, if you're going to sell stocks, you're going to sell bonds, you're going to sell gold, you're going to run for the hills, ultimately you have to do something with that money. The continued increases in interest and dividends, the continued capital flows that come into pension plans, insurance companies, 401ks, there's no alternative of where you can go put that money right now. It isn't like the 1980s, the 1990s, and even the early 2000s. Terril and company, along with many other people, bought a lot when we became concerned of 2-year Treasury bonds yield 5–6%. There was an alternative of what you could do with the money. That doesn't exist right now. For the people that are selling all this, if they are going to sit in cash, they're going to make nothing to a negative interest rate depending upon where they're at. So you come all the way around about potential investments to the fact that one of the biggest positives the markets have is the fact there's nowhere else to invest money. The demand for borrowing money is not that great at the moment. So no one's standing there willing to borrow money from you and pay you a nice interest rate on your funds. There's not a lot of new corporate IPO equity issues even. So your choice of what to do with funds is very limited. And this, I think, ultimately will come back to support the market. That and the fact as some time goes by and people realize that the world economy isn't getting ready to fall apart, we're not going to see everybody go into severe recession, we'll see a return to maybe a more normal, if you will, investment climate. Prices right now are 15% off recent highs. I think by the end of the year, the markets will continue to be volatile, but by the end of the year, we'll probably see prices back to the point where maybe we're only down 2 or 3% on the year. If not by the end of the year, maybe by February. So in general, we remain cautiously optimistic on stocks and bonds. See nothing that leads us to believe interest rates are getting ready to go up all over the world, therefore it's going to kill economies and it's going to ruin stock and bond prices. No, quite the opposite. Interest rates are staying down, even, if you will, with all the talk about interest rates going up in the United States. The 10-year United States Treasury bond today at 2.14% is lower than where it started the year. If people really believe interest rates are going up, why is the U.S. Treasury bond at a lower yield? It's because there isn't any demand for money out there, and consequently interest rates around the world will stay lower until we see a dramatic pickup in the world economy. So in general, because we believe the markets have overdone this pullback, their belief about corporate profits going down dramatically is overdone, and more importantly, there's no alternative, there's no other place for people to take funds and invest them. I hear comments that, well, our stock market sells at 17 times earnings. Sure, there's no reason it can't sell at 20 times earnings. 20 times earnings is a 5% rate of return. 5% is better than zero. There's nothing there that says, well, markets are supposed to sell at 12 times earnings, which is a 8% rate of return. Well, they are if interest rates weren't zero. So the spreads between these, it's a new normal is the term that people use. There's a new normal out there. So we believe at Terril and Company that a lot of these investments are going to return to quote unquote more of a new normal, and you're not going to see prices fall to the point where they go all the way down to where they're only selling at 12 times earnings, because that's what they sold for in the 1990s. This is not the 1990s. The world has changed dramatically. So we continue to be cautiously optimistic about overall investments, and we think somewhere along the line they're going to have to go back to bidding up the existing price of existing stocks and bonds. Thank you for joining us today. Once again, my name is Joe Terril, president of Terril and Company in St. Louis, Missouri. Private wealth managers with approximately $750 million in discretionary assets under advisement. And Brian Curtis, I thank you as always for helping us with our video cast today. And we will be back probably in the next 30 to 45 days with an update. Want to also remind you that we do also post written comments on our website in between updating video cast. So once again, thank you for joining us.